Can you all hear me? Can you hear me? Thank you. Thank you. Thank you. Thank you. All right, good. Let's get going. We have a full plate, shall we say. Let's get going. First thing I want to ask you is if anyone has any questions before we get going. Okay. Then first thing I had on the agenda that you can see in this slide is to give you a bit of a heads up on the state of the course of this class. All right? Couple of things. One, we have some very good discussions going on. See, really good. And so there are some themes that people are catching on because there's so much to say and so much to about. But there's others we haven't seen yet. So there's two things that I want to say about these discussions. You can see this class, it's a seminar class. It's like a research methods class. It's, the learning all depends on how good and stimulating these discussions are between each other and the animation and the passion. And I can see some of that happening. I'd like to see more. And as you see, I get involved. When I see something, I get involved sometimes. Sometimes I'll just make note and say, I want to discuss this in person when I meet you in class. Because pretty much now we'll move into this mode where, you'll have me for discussion for the whole time. And so at least an hour, sometimes an hour and a half, classroom discussions on everything that's going on. Two things, I don't see enough activity in groups 2 and 3. I want you guys to catch up and start posting stuff that you think you need to discuss as a group. Discuss with yourselves in the group, post it, and seek replies. Seek replies, and talk together and do that. I see group 1 doing well. If you are confused between blogs and boards, don't be. If you are comfortable with boards, I think most people are comfortable with boards. Go with the discussion board. Everything has a discussion board. Go with that. Forget the blog. Just whatever you've started, I've looked at it. Continue with the board. Doesn't matter to me. Let's keep talking. That's one. So I want some action and activity starting. I've posted some stuff in group 2 and 3 boards, and I don't see any response. That's not a good feedback for me. So I'd like to see some feedback from these groups, some discussions going on as a group on these very similar issues. You can see all the issues are similar, but now you have 4 people thinking together as a group, and I want to see what four minds go, or 5 minds in one case, when you come in together and post something together. How powerful is your posting? How well thought out? How well reasoned? You guys have discussed with each other before you post. And that's the point. So I want to see that quality in the group postings and responses, group responses. That's all it is. It's about discussion. And I'm starting the individual ones, you'll see, and I'll keep starting others, sort of like lighting little fires, hoping that some of them will catch. And they have, like, say, hyperbolic discounting. And we'll talk about all that today. That's what. So please note, groups 2 and 3, I'd like to see more. Hold on, David. I'll come to your question in a moment. That's one. And Lisa, you too. Just hold on for a moment. Second, what I'd like to sort of look at is the material from the chapters. So, for example, in chapter 8, there was a lot on anchoring and, study on all these different biases and chasing winners and, representative bias and heuristics and brand identities, all these kinds of things. They need to be discussed too in the same format when you're discussing investors because you're learning about this stuff. That's one. Lisa, going to your question, I've seen your posting and no one has posted a response to yours. So let's start another discussion there. I know you posted it, I've looked at it, but I don't see anyone else responding to it. You also have a group. Talk to your group, saying, hey, what do we need to discuss about in our group? Why are we not talking? You're losing time. Group 1 is ahead. If you go to group discussion 1 in the discussion board, you'll see there's a good discussion going on there. Why is it not happening in group 2s and 3? That's your group issue, and it's going to reflect on your grades. So that's one. And bring in the stuff from the book chapters too, not just the readings. I want to see it connecting up. And take initiative, Lisa, or anyone, Kevin, anyone. Take up the leadership of your group and say, let's meet and let's start posting right away. Come on, there's lots of issues to discuss. There's so much reading, so much stuff. So, so please note that I'm sort of like trolling through all your discussions, looking at who's talking about what, when. I'll jump in whenever I see something that I want to jump in on, I will jump in. But I see you guys discussing, look at the 3 or 4 vigorous discussions. That's great. That's the model. That's what I want you to be doing, all right? So, all right. I want to stop because we'll continue now with the rest of the agenda. Someone had a question. David, have I answered your question? You've taken up
I think so, but I just want to verify. So when we're doing our postings in our group, should we only stay within our group, or can we go outside our group and make postings too to the other groups?
You can post things to the other groups as a group. Put together your thoughts as a group. You're 4 people. How much brain power is that together to come in and say, hey, look at what this group has posted. This is our response to them in their issue. And then you post an issue in your own group. What's of interest for your group to know? Which group are you? Tell me that.
I'm in group 1.
Okay, so investments, right? So what do biases do? Outcomes on biases. What happens when you have bad biases? What happens if bad outcomes? What if you keep losing a lot of money? What does it do to your mind? And that's a really good group posting for the health group to post. How do you deal with that? So you can see the investment group posting a response to the health group. And I've something like that. So that's the way you want to, the group work should be a joint work. Whatever you want to say individually, you have 3 individual discussions on the same subjects pretty much. Pretty much, just a different format. But you'll see you can make same references, but that's your individual opinion. You don't have to sort of work together as a group. That's your individual stuff. You go as deep as you want to in those. Is that good?
Yeah, that's good. That's good.
Okay. All right, good. Any other questions before we move on? All right. So this is our agenda. I'm going to take these 4 questions. I've seen this come up through various discussions. These issues have come up. So I'm going to sort of duck them. And here's the format I propose. I'm going to provide my opinion and, brief opinion because I can't put everything together in a class like this in 1.5 hours. You'll see how much information I'll bring to you today. I don't want to bring more because you need to digest this material as well. And you'll see that you'll need the time to digest this material, the content. So in this case, let me first provide an overview of fiduciary, education, saving, and spending. After each, I will ask for your questions and comments because you've brought up these issues. So you can please add to the discussion at that point on these issues that you are bringing up. And this is an issue that I see that's coming up in different sets, in different ways. Like someone says, you have to care enough to educate your client. Someone says, hey, how do you get paid? Commission versus fees. And the other says, taking care of your clients. How important is that? The whole thing, that argument or that discussion is all about fiduciary. What is a fiduciary? As a financial advisor, you're a fiduciary. That's a legalese. That's a legal obligation of a planner. And it's implicit, generally implicit. It's an unwritten contract. Even when you put together a plan or something, there's an implicit contract that you will put the benefits of your client ahead of yours, right? You'll serve your client first, then yourself. It's okay to serve yourself, but in every respect, your client comes first in any conflict. All right? So that's, in a nutshell, a simple layperson's definition of a fiduciary. You take it to the courts, it takes a whole different dimension. Lawyers will do that. So, but that's the basic idea. To do that, to put your client first, if you think of it, whose life savings you're managing. And you've heard me say this, that, how competent and ethical do you have to be if someone turns over their life savings to you? And how sacred is that task? Understand this, that when I say it, I'm sort of making you emotional. I want you to feel it. It's not a reasonable thing. I'm saying something reasonable. It is reasonable, right? When a 60-year-old turns over the whole life savings to you, saying, "I've got 5 years, help me lead my retirement life," and then the market blows up the money, that's a sacred task. So when I say something like that, I am sort of, I hope it's gentle, but gently poking at your emotions. So it is a very emotional issue for the advanced competent planners. And what's an advanced competent planner? A competent and an ethical planner. In a nutshell, a competent planner knows what is suitable for the client, right? That's sort of the professional jargon, the use. The people from registered reps, RIAs, to all the alphabet soup, the CFA, CFP, CPA, everyone will use, right? The suitability. What I'm suggesting is best for the client. Now, in most cases, proving that something is not best for the client is difficult. And you can see it gets up. It's like, what's suitability? If you look at the sort of the broker-dealer framework, suitability is whatever is internally done. So, the wirehouses have their own training program, and you have to pass it, and so on and so forth. And it's in compliance with legal requirements with the 1933 and the 1940 Act, but it's very difficult to prove. Unless, for example, I'll give you an example where suitability sort of butted heads with law, and that was selling variable annuities to retirees, right? So it was like, that's a bad deal. Retirees do not need to postpone taxes, defer taxes anymore. So you shouldn't be selling variable annuities to retirees. So there was a law against that, which the wirehouses are still found today to undo. But there's very good reason for that. It wasn't suitable, and if enough people did it, the SEC would pull you up. But in a case where you're selling one, value fund over another, who can say that this was not suitable for a client? So understand those issues, because it brings in how competent do you need to be to someone's life savings. And the ethics part is like, it goes back to it. It's like, I'm not so big on the issue of fees versus commission. I think you can be unethical no matter how you take your compensation. Though the temptation in a commission framework may be higher. I agree. If you are sort of taking, and I'll come to that in another question, another situation. But, as an advisor, you also have responsibility towards your family. You have to sort of pay the mortgage, bring the bread to the table to your family, right? So that also is an allegiance that you have, which is probably at least equal to your clients. Sometimes it's greater. And if under temptation or stress, there is a likelihood that you might make the wronger choice. Pardon the English. But as far as I'm concerned, for you guys, the 11 of you who are here today, it doesn't matter whether you are in a wirehouse, getting commissions, fees, or both. You are competent. You are preparing yourselves to be competent ethical planners, no matter what the people around you are doing. Because you can be unethical on both. And we know that. And so then there are temptations on the other side. But ethics simply means at the end of the day, you can go back home thinking, I could have done better for my client. Really. And when you take up that responsibility of managing someone's life savings, how sacred is it? They have kids too. They have parents too. They have kids too. So in that sense, you can see how it's like a doctor. You can see why I keep bringing you guys up as financial doctors. You screw up someone's finances, how badly hurt, just like a doctor does, malpractice. They really hurt their clients. So you can see that. Now, fear and greed and your own behavior and the client's behavior become big parts out here. So for example, under fear, I'll point out some things like client behavior under fear. At the end of, say, by March, April 2009, which was at the bottom of this pit that we've been in, a lot of your clients might have been saying, hey, get me out of stock. And, I want to buy me CD, get me out of whatever you can, get me out of this kind of thing. And that's a really tough place because right now we don't know. It's a retirement plan, and let's say they've got 5 years left. It's a different situation than if someone has 25 years left saying, my guess is as good as someone else's that, stocks will last. But what if it's in 5 years? And how does your fear play into that? Saying, what if I keep you in it and this market doesn't recover? Or greed, in this case, saying, hey, this can't go on forever. Let's get into stocks. And I'll come back to that on the last item on investment today. It's like, let's look at this issue of what we can invest in right now. It's a scary, scary situation right now if you're a financial advisor. From my point of view, as an investment advisor, I'm an investment advisor. It's a scary place to be. I don't know what to recommend at this point. And I'll come back to the last discussion. All right. I'm going to stop here, and I'm going to turn it over to you guys for discussion. Please. Questions, observations, anything. Go ahead, Greg.
Well, the problem I have is that you could be under the suitability standard and, in essence, make an investment recommendation to a client and not do what's in the client's best interest and still be ethical because you're.
Hold on. You made a decision which is not in the client's best interest. Did I hear that right or no? Tell me no.
Maybe I said it wrong. I'm sorry. There's certain broker dealers out there that are under the suitability standard that have limited their products so much that, or maybe this was the case in the past, but I think it still goes on today, where you can make a recommendation and it's not in the client's best interest.
Yeah, Greg. Yeah, I understand that. We all understand that there's a lot of confidence people in this trade. Let's not get lost with them. Or I'd say 60, 70% of the people in this industry who call themselves some kind of financial someone. It's an alphabet soup, CF this and CH this and whatever, financial advisor, investment advisor, financial planner, whatever. There are about 60 to 70% who are salespeople. Let's leave them out. Let's talk about our competition, people you're going to meet with who are at this higher scale. What happens there?
Okay. You mentioned that there's some interference somewhere in there. Okay. You mentioned that financial planners should not put their family first. No, in some cases, can put their family first instead of putting their client first. I disagree with that.
No, I didn't. Wait a minute. Where did I say that? Where did I say that?
You did.
I said they're at least equal at some point.
And you
because
said,
they have kids too.
Correct.
I'll come to that.
I think you did mention that in some cases it could be more than the client.
Correct. Right?
I totally disagree.
And why? Okay. All right. So please provide me some reasons. Hey, wait. Put it in a discussion, and I want to hear your reasons in the discussion. Post it. All right? Post it.
Okay.
Online. All right, good. Anyone else? I will come back to that. That's utility maximization. That's a totally different area, and we'll come to that because that's leading to biases too. That's a problem because when we work with our family, we are fiduciaries. So when we work with someone else's families, have to be equal, and that's an ethical question, and I'd like to take that discussion up. So please do post it. All right, next. All right, education. Uh, this has also come up over and over again, and it's really, really important, as everyone can understand. And as someone pointed out recently, it's sort of like also overwhelming. How much information is there? You try to teach your planners, all clients, all this stuff. They will collapse. They will say, get out of here. I don't want to deal with all this stuff. So you got to really sort of take the material that's important and work with them in such a way that it helps them, it works with them. And I've seen some wonderful idea like storytelling, building relationships, storytelling. I think those are wonderful ways for client education and building relationship. Because when you educate, like look at me and my students, it's relationships I've built over the years. And it doesn't matter, like we have to be able to agree, disagree, but we are exchanging information, we are educating each other, and we are building relationships. And you do that with your clients too. Here's one of the things I want to point out with client education that's really important, and it goes back to how competent you have to be in managing someone else's life savings. Here's the thing. First thing that you want to do is once you feel good about what you do, how much you know about investments or retirement or whatever, when you feel really solid about your knowledge of that area, what you should do is spend a lot of time upfront with the client on the education part. And I'll tell you this from my observation. When I taught at Denver, at the University of Denver, at one time I moonlighted, and this is sort of like a war story for you guys. I moonlighted with a company which, they needed someone. They had an estate planning business, and they had about $60 million of investment money, which they were mismanaging. My students was there in that company, and he brought me in. So, and I was the chief advisor for that portfolio for 3 years. And I did pretty well, but that's besides the fact. The main people in that fund of that 60 million were high net worth individuals, people who had $10 million, $12 million. And so there were not too many people who had windfalls, lotteries, and they won $7 million, $10. Uh, not too many people. And so what I had to do, my job was at the beginning, sitting down like with, over sessions, 1 day, 2 day, 3 day, just discussing like I'm discussing with you about all this stuff. I would discuss with them all this stuff about, what their returns are, what their risks are. If they want to make so much, say 5% over the inflation rate, then that would equate to this amount of risk. And can they take such a loss in any year? What if the next year they took a 25% loss? How would they feel? Would they be able to take it like that? And these are the kinds of macroeconomic conditions that could come out. All right? These are the types of macroeconomic conditions that come out. And how would you react in these cases? How would your portfolio do? So I would spend a lot of time, but I'm a professor, so I sort of know this stuff really well. I've been doing it for 25 years. Well, that time it was 15 years or something. So I do this over and over again. That's my profession. So I'd spend a lot of time giving them scenarios of all the different things that could happen in the future with these likelihoods and what would their portfolio look like, and could they live with that? And can they go to sleep knowing that they're in good hands? Am I competent to do it? Or are they going to say, hey, this guy is going to blow my money. What am I going to do? Where do I go? This is like a bad doctor. I've heard this guy's a bad doctor. Can I put my life in this doctor's hands? What do I do? How do I find that good doctor whose hands I'm going to put my life in, who might not treat me like, people he or she cares for more? What do I do then? Right? So, in this case, if you think about it, your education, as you're healing yourself, you got to start thinking, and you are. In these discussions, I see that happening in you. Is that, hey, we did this with our client. This is something we can do. And we shouldn't overwhelm them. So you understand some of these issues that come in. Can you identify biases? Can you identify their fears and say, hey, look, I understand you're afraid for these reasons. What if your portfolio lost so much money suddenly? What would happen? And how do I help you from that happening, right? How do I help you from that happening? So in this case, as you learn this, the more you can tell your client all the different things that could happen from what they want in their lifestyle, given their lifestyle, their savings, all given their needs, what could happen to them, the more you share with them the stories, bring in people, real people. I think that's a great idea. Someone that talked about, bring in a real person with the experience of what happened to them, and maybe, it could have been turned out to be a good story after all, or not. And, what someone had before and what they have now. There's lots of other stories there too. But education, storytelling, I think is a wonderful way of building relationships. And the retention part of in clients comes from that relationship, right? Comes from that relationship. So planners' ability to educate is two things, your good knowledge and effective delivery. There are many professors who know a lot, really smart people, can't teach for nuts. Who can't teach for nuts because they don't know how to sort of effectively open up sort of the receivers in the students who are really thirsty for this stuff. You guys are thirsty for this stuff. I see the stuff, the passion going in, and I know this is what you're doing on a day-to-day basis, and suddenly it's coming up in the forefront. The mechanical stuff of putting stuff in a black box like modern portfolio theory and coming up with optimal allocation charts. That's the easy side. This side of trust and hand-holding is the difficult side, and it comes through education. An absolute key on a national scale. It's, think about the analogy I've used before about medicine, like 12 to 15 years, and doctors having to be ethical and so on. So, what if there was a do-it-yourself kit for your appendicitis and you had a pain and you self-diagnosed? Are you willing to do that? Nationally, the only things we know about our health is that good diet. What's good diet? What's good exercise do for your health? What's good diet do for your health? To deal with stress. General education. What's the general education on the financial side amongst all people? Do they know what is a reasonable expectation of returns under different conditions? Do they know how important saving is for their future? That's like diet and exercise kind of stuff for finance, right? Save early, save often. That's a good mantra of sorts, right? Like vote early, vote often, like, Chicago Mayor, what's the guy's name? But it's sort of like that. So your ability to educate, I mean, I've put up the EBRI stats, Employee Benefits Research Institute. Go in there and look at what they have, the reports they have, how screwed up people are with their retirement plans. It's scary, absolutely scary. The average boomer is going to retire every year, about 1 million or 2 million are retiring. Average boomer is going to retire with about $150,000 to $200,000 in their 401k plans, and they will take it in a lump sum, and most likely they'll spend 20,000 of that buying a Cadillac or something, because that's what they've always dreamed of. And they're spending $60,000, $50,000, $60,000 in their current lifestyle. And it's scary. And that's like ignorance, right? So as financial advisors, you can see when you go to a doctor's office, right, they spend a lot of time explaining the diagnosis to you and the treatments to you and stuff as best in lay people's term that they can help you understand, right? Every time you go to a doctor will take the time to talk with you, right? If you take your kids, I know I've taken my kid, and the doctor will take a lot of time because it's, they cannot talk technical with us. We don't understand Roman, Latin technical terms. But they will talk to us about ordinary stuff and what we can understand and say, all right, this is your disease, your illness. These are the treatments. These are the possibilities. These are the byproducts, the results. And this is what I'm suggesting doing, right? So you are in a similar position. And that's how you got to think about diagnosing. These are the problems you have. Hey, you don't need whole life. You need term life. Why do you need whole life? Most people need term life, right? So why do you want whole life? Take that money and invest it properly. So why is it term life? Why is it whole life? That's a simple question. Where do you defer? Where do you use whole life? Where you defer income from taxes? So in a whole life thing, in any deferred product, you will not put low income product like capital gains. You put stocks in a 401k plan. If you can put it outside, you put it outside. Say if it's a low dividend or zero dividend stock, it's a growth stock. What's the use of putting it in a 401k plan? There's no deferral of tax. That's all capital gains taxes and ordinarily deferred. You don't need to hold it in a 401k plan. So why do people do that? Why do people put an IRA in a 401k plan? A deferred tax and a deferred tax. You're talking about fiduciary issues. These are, how do common people know of all this stuff? How will they ever learn that these are things that shouldn't happen to them? Just think about stuff that you guys know and what people don't know. How do you effectively tell them, look, I'll take care of you? I will. I'll take care of you the best of my ability. And that's also part of the education. Your client goes to sleep in the sound knowledge that they won't get hurt by you. What have you done? That's a good doctor, is it not? So that's education. So I'm going to stop here and turn to you for comments.
Yeah, I find that it takes a lot of time to educate clients, and it's easy. We all like to say that we want to spend as much time as possible educating clients, but where I get frustrated is that I feel like it takes up all of their mental capacity just to understand what I'm trying to explain to them, and then by the end of it, it's become more difficult for them to make a decision, or they get paralysis by analysis. And so what I have trouble with sometimes is finding the right balance between those two, the proper education, or sufficient education, and then when to transition into, helping them actually make the decision versus just sit there and be stumped.
Yeah, that's very good. And I'll my immediate spontaneous thought, I go back again to the doctor. Let's say you have a difficult disease, and it's difficult for them to explain what's happening inside you because we don't know what's inside us. How do we effectively tell them to calm them down and sort of give comfort that they're going to help them, you're going to help them overcome their problem? It is difficult. You're willing to help them, but it may be useful to take the time. And as you yourself pointed out, it takes time to educate clients, but it takes time to build relationships as well, does it not? So it's you need a lot of patience, understanding about exactly what you said, that these people are at their end. They don't want to hear about any of this stuff. They want to feel comfortable that they're in good hands. And how do you tell them the right things to placate them, to make them feel at ease? Just like a good doctor does, even with difficult diseases. What else can you do, right? Sometimes. And you're in the very same position, very, very same position. David?
Yeah, I think the clients, they expect us to be educated. They come to us because they believe we're educated, especially high net worth clients or sophisticated clients. But the key that I found is it's the relationships. And the relationships sometimes take years and a lot of time, and you have to give continual good advice. And so it takes time. And then the best clients and the best way to get clients, I found, is through referrals. If you do good work with your current client base, and they trust you, you get referrals, and that's the best way to get clients. But education, the way I've noticed is, I've got all the initials and experience, and they don't come in and ask me, are you a Series 7 or RIA or CFP? They want to know that I've been doing it for many years, And that's what's important to them. And it takes years to build that trust and that relationship, and that's the key. You got to do it consistently.
Yeah, absolutely right. Wonderful. And you can see this. I mean, this stuff is like, this is the hard part of financial advising. The easier parts are like more your theory and efficient markets and all that, which you can just put into black boxes. Much easier. All right, here's the next one. And you can see on the effect on I mean, these things have mental problems. Look at this issue. The effect of ignorance. I mean, if you keep making poor decisions and spending your family's money, how much does it hurt you personally? Because you were ignorant and you thought you weren't. You see that a lot. You see doctors who think doctors think they're really smart. And doctors have all sorts of problems with their finances. And doctors make great clients. People know they have money. And they are very smart people. But it's just like us doing our own medicine. Saving versus spending, all right? I put some links on my FBA blog for you guys. You can go and look at it. The last one was on this marketing gurus. And here my point is, there's two things, and we are coming back to Greg's question about personal utility. And so let me go with that. Maximizing of current personal utility, my own present value, my family. Even before my family, it's me, right? It's me first. What happens to my kids comes second, and that's the boomer generation. So even higher than my family is myself. If it came between yourself and your kids, which one would you choose? Right? And I've asked this in class with my students, most of them. If I had to say, right, you have to make a choice now because you boomers, we have spent so much. You're going to take the bus from now on to work so that your kids can go in cars. Otherwise, you go in cars and it's at the expense of your kids. Your kids will go to work in buses and work in lousy conditions. Which one will you choose? And my students have always pretty much said, we'll choose our own personal well-being over our kids. So it's not just, it's just not my family. What about within my family? What about me versus my family? Right? Who do I take care of first? What if it's a choice? Maximizing of current personal utility, that's the theory of utility maximization. And Greg, you're coming up with that. You have to think when you say about your family, who's your family? Does it start with you? What if you had to make a choice between you and your spouse in a condition of life and death? Who's your family? So personal, the theory of the market says we maximize our own individual utilities first. In the new economy, I'll show you what they did to their children and their children. We've outspent all their monies. Absolutely. In the long run, Lisa, the ethical way is also the utilitarian way. Absolutely. If you serve your clients right, just like your kids and your parents, in the long run, you are the best planner. You're going to have the best practice. In the short run, you might have to tell some clients, I can't work with you because I can't do what you're asking me to do. Even when you're struggling to build a practice, you have to be able to turn away a client saying, no, I can't take you because I can't do what you're saying you want me to do. You want me to take this risk but not lose this money. I can't do it. So underlying every decision we make, we optimize our own present value. Mine first, then my family's, then anyone else's. That's the theory of utility maximization. Theory why capital markets work so well. And I won't go into that. That's a different discussion. Think about the issue of spending versus saving, all right? It's about the future versus the present. It's about right now, me now versus me later. Or me and my family now versus me and my family and later. And me and my family and others now versus them later. If I have to be happy, if I go looking into the future, I want to be happy in the future. So my best predictor of the future is today, right now. Am I happy now? What will make me happy now? Consumption. To consume things right now will make me happy. The more I can consume now, the more I have present value now, the happier I get, which is my best indicator of the future. So the impetus for spending today and not saving, it's huge. And if you go into a Weber paper, that's what she's talking about. She's saying that our old limbic system, the mammalian brain and the reptilian brain, they've taken like 20 million years or whatever, 200 million years to evolve, since we were cave people or whatever. The cerebral brain, the analytical brain, the logical brain, that's about 2 million old, right? Whatever. This is the theory, at least, in neurosciences. It's about 2 million years old when we started thinking reasonably. We started making weapons, for example, and fire and weapons. That's 2 million years old, right? So the cerebral brain and the limbic brain, they're two systems. The limbic is the old mammalian brain when we were cave people. So it's had a lot longer time. It's much bigger, a lot longer, but it doesn't think. It reacts. It's an instincts kind of stuff, animalistic. That's the current personal utility maximization. It reacts to uncertainties. Is there an immediate fear, first of all? Uncertainty. What do I do? Like I'm trading into someone else's territory, for example. I'm a bond dealer. I'm trying to sell stocks. All right? So what do I do? Immediate uncertainties. Will I get food tomorrow? If I don't, if there's a flood around me, what do I do? That's an immediate threat. And then there are threats of disaster. Disaster, like, losing my job. Wife and I both get laid off. We have 4 small kids. And it's, 10 million people have lost their jobs and we can't find a job and we have to feed our kids. What do? That's a disaster threat. So the level of the threat tells us which part of the mind takes over. The bigger the fear issues, the cerebral, uncertainties, something wrong can happen to me, the more the limbic system will take over. Even if the cerebral one says, hey, listen, retirement is like you have to plan for retirement. If you're broke at 80, you're going to have a horrible life. The limbic system says, hey, I'm just 40 years old. I can't see that far away. Why should I have to do something which I see benefits 40 years away? Like giving up smoking or losing weight, where I see benefits immediately. There, the analytical side and the limbic side are in cognizance with each other. They're talking with each other. When they both have the same decision, it's okay. But if the cerebral analytical brain says, hey, you've got to save for retirement, limbic says it's too far away, I want to use this money on a date, big one will win every time. If there's no threat, no feeling of threat, I will always optimize my current utility. My spending today makes me feel good, so I won't save. Saving is for the future. That's another day. It's living one day at a time, right? So we understand that. We are utility and that's why we have built this capital system. It works well when we behave like this. Yeah, it's underlying free markets. That's when markets work well, when we all optimize our own personal utilities. But in this case, it's in conflict with the cerebral brain, which is saying, you should save for a rainy day. It's like squirrels squirreling away nuts for winter. What's wrong with that? That's also part of our nature. How far do we go? How far do we prepare? You can see everything is connected. Education. Go back to that consumer behavior article. Look at the people who study consumer behavior. When I was doing my PhD in finance, I had friends who were doing PhD in marketing, all right? And they were into consumer behavior market research. And they would do sort of like most sort of outstanding work. I mean, they would start viewing, say, the purchase decision. Where does it spring from? When someone is watching, some kid is watching sort of, say, Barney or something, they see it triggers an ad triggers something for them. They cry. Mom says, okay, I'll get you one of those. So that's a decision being made from someone instigating the decision. So these people, very smart people, they study the inside and outside of how we make spending decisions. And then they sort of titillate us through media. They exhort us to feel good about ourselves. with the gratification, not to delay it, which is the reasonable one. How do you reconcile that regret? Yeah, because right now you're getting bombarded with saying, you could be a happier guy, and society said, the happy guy is what it's all about, the winners. You don't want to be a loser. You want to be a happy guy today. So these people are coming after us. We are financial advisors, understanding what's happening to our clients. Do our clients understand that? What chance do they have of resisting the powerful force of marketing, whether it's e-commerce or internet or retail markets or direct markets? Look at all the different ways we get bombarded, exhorted to buy, right? And it's underlying our messages inside us, behavioral sort of, what do you call these things? What do you call these things that make us feel good? The neural stuff. What's the word for that? Come on, just who knows the word? Which we feel when we feel good, when we have food, or so when smokers have a smoke and stuff. It triggers these endorphins. Yeah, endorphins, and there's some other stuff. Yeah, these are feel good chemicals. I'll get the name of that exact chemical. It's a chemical reaction inside our head that we are looking for, and it's endorphins. And there's another word for it. It's skipping me. I can go to Google and find it right now, but I'll have it for you in an email. What that word is, but it's it's like these serotonin blockers that they have for depression. It's not making us feel good. There's a feel-good chemical that we trigger with spending, and that makes us feel good, like other things, like someone with alcohol, drugs, or with shopping, or with cigarettes. That gratification, there's a biochemical reaction inside our heads which makes us feel good. And we want that. Oh, come on, it makes me frustrated. It's at the tip of my tongue, but I can't get it out, the word. But when I do, you will say, yeah, we know that. So that's what saving versus spending is, the power of that feel good, that biochemical reaction in us. It's a hormonal thing. It's a biochemical thing. It makes us feel really good. And we are combating that with our clients behaviorally. So you're talking logically about all these things, like Blake, you've been talking about that. How do you counsel? And many of you are saying the same thing. How do you educate? But they're thinking a totally different way, and someone else pointed that out. You're saying something, but they're thinking something else. How do you know what they're thinking about, and what are the behavioral issues of your clients? All right, I'm going to stop here. Questions? Then I go to the last one. And then I'll talk about the new economy. Endorphins, when you go after, runs, physical exertion, that's when you get the endorphins. And they also feel good chemicals. Yeah, exactly. Same kind of stuff. All right. If not, let's go to the next topic. And this is a scary topic. I'm going to put my hands up. I have been studying investments only for the last 25 years. In all its way, and I still don't know it enough. When I advise, I have some clients, half a client, but they're very rich people. And I will tell them, look, this is the thing. I know as good as anyone else what's going to happen next. But I have an idea of all the many things that could happen and what would your portfolio look like. And you can tell me whether you can live with it. But I don't know what's going to happen next. And the same for all of us. But in today's world, more than anywhere else, it's much more so. It's like, Blake had a question earlier, like, how can you not tell someone to buy stocks, especially if they're young? What do you say? And so, I'm on a fund committee where, I make decisions with the board on how to make money. It's about $40-50 million. And recently we had some presentations by money managers on investing the money. And so here's something that they said, and it triggered my mind, and I sort of started questioning them, and I've taken this up in other forums too. they were going through their asset allocation decision. They were talking to me about their underlying assumptions about risk and return of the underlying securities, large cap stocks, domestic, international, small cap stocks. What's the risk? What's the standard deviation? And what's the expected return of stocks and bonds and commodities, currencies, real estate, REITs, all these kinds of things. And so this guy says that their expected return on stocks right now, large cap stocks, is 7%. And this is a long term, and in this case, long term is 5 years. Every 5 years is a long term period where they get evaluated for performance. And I said, wait a minute. The historical long term rate is 11.5% on S&P. And that's like, over the long bond, the 30-year bond, which is 1.5% historical average rate, that's a 6% risk premium on the risk-free rate, 30-year risk-free rate. 6% risk premium for equity, which is what you should be expecting. If you buy something of that risk, the trend line should be at least 6%. It's a random around the trend line. But nonetheless, in the long run, large cap stocks, if you hold for 20 years, 30 years, 40 years, on an average, you should get about 11.5% after 40 years. Really long run. And now you're saying 7%. That's one. So now, and the long bond was at 5%, which is not true either. The long bond is close to 3.75%. I'll come back to that. But that means the current premium risk they're saying is 2%. And I said, look, go to the volatility in the market. Go and look what volatility has happened since 2008. It's gone up 30, 40, 50% from average volatility. Even in the VIX index, if you go and look at the VIX index since 1990, which is the volatility index, you'll see it since 2008, volatility has gone up 30% or so, 40% in the S&P market. In the new economy presentation coming up, I'll show you that the slide. So volatility has gone up 30, 40%, risk has gone up 30, 40%, and risk premium has come down from 6 to 2%. Why the heck should I buy stocks? And they couldn't speak. And they started talking, and I think it still doesn't matter. You're diversified and all that, but why would I buy stocks at 7% expected return? And it's not going to help, and I want that in the minutes. And of course, that's my point. And so how do I do it? What is happening? What about bonds? Since 2001, since the dot-com burst, the bond market has been at its peak. It's been an awful time for clients who need to get into bonds, 55-year-olds, 60-year-olds, 65-year-olds, who need to transfer from stocks to bonds to get into bonds. Bonds are at the peak. You don't want to buy high. But right now, bonds are at the peak, and you will see something really funny. I'll show you this new language coming up. It seems like a high bond market is called a pessimistic bubble, people being too safe, and I can't stop laughing. But we'll come to that later on in the new economy. So, issues in investing in today's world. What do you invest in? It's really scary. So if it was 1933, what do you think financial advisors then? What kind of a shape would they have been in advising clients what to invest? Does that make better sense in that context? Think of yourself that, you've just had the 33 Act, SEC Act. You've got some clients. You're selling stocks, bonds, whatever. What would you do? How would you make a living in 32, in 33? As a financial advisor, you're living the same life today. It's not different. I can say, all right, this is a little dipper if it's a little dipper. It is a dipper. It's a depression. If that was the big dipper, this is the little dipper. What do you do as a financial? What do you advise? Commodities? Diversified portfolio with currencies, with real estate, with commodities, with cash, stocks, bonds, domestic, international. Diversification is going to help. Did it in 2008? Didn't help. What do you do? And what about the people, how afraid are they? And when the market goes down, does greed take over? Say, hey, this is a good time to get in. Or do we say, oh, wait, the present values, have they gone up? Is it correctly valued? Ask yourselves rationally. Talk about the competency. If the market goes down, let's say now to 9,500, would you think it would be a good time to buy? Or would you go back and rework the values and see if any stock is really truly undervalued or a mutual fund's net asset value is truly undervalued? Will you do the math? Will you do it, or will you think, no, it's a good time to buy? The market can't go down any more. What would you do? Think about that. That's where you are right now. It's unknown territory. So one security is stocks. What do we do with stocks? What kind of stocks? Large caps? Large caps international? Time frame, correct. But, in 1933, the benchmarks all changed. And it tilted towards stocks. Is it going to tilt away now? We don't know. Sitting and, think about it. Yeah, in the last 80 years. Before 2008, that's exactly the answer we would all give. But if it's 1932, would you feel the same way? And you were advising for the last 30 years? Yeah, but not like this uncertainty, right? We are always at a point of uncertainty, but this is like a disaster uncertainty. How big was the dipper? How are we going to get 10 million people back into the workforce? We have lost their productivity, so we are not consuming what they were producing. We've lost their income, so they are not consuming what they were consuming. We've lost their taxes, so the government cannot spend what it could be spending. Prices are going up. How are we going to sort of work with this? How are we going to get people to think rationally at this point when fear is so much overbearing? Yeah. And so this is the way you discuss it, David. Discuss it just like this. You cannot know. You cannot know. You have to try your best. You have to be the safest. At this point, the main thing is how safe can I be? Because it's very difficult to advise on anything to buy or sell. And, that's because of this special. Yeah, every day in 2005, 92, hopefully 2013, 14, people will get back to that track. But we are at a special point where we really don't know what's going to happen because of this major change. And if you don't have any questions, I'd like to take you quickly through the new economy as I'm going to present it. I'm going to make a little bit of change, but that's pretty much what I'm going to do next. Any questions? Hey, I write stuff on this all the time. I'm into this behavioral stuff is just like I spend most of my time doing this stuff, You'd say, yeah, well, yeah, black swan, what else could, you have nothing better to do. And that's very true. I have nothing better to do than do this stuff. I've been doing it for 25 years. It's fun. But, nothing like this. And, ask any depression era person. Why can none of them ever forget about the depression? Do you think you're going to be any different? You're going to tell your grandkids, hey, I lived a 2008 Little Dipper or whatever it turns out to be. And it's going to turn out to be something. Yeah, this is a black swan. It's happened to us. Just like the depression. Everyone knows depression era people, and they're all the same. They have that same experience, and they don't let go of that. Right? They don't let go of that. Major experiences for a large group of people. Think about the Holocaust. They're not going to let go of that. It's such a strong impression. This 2008 dipper is like that. It's like that. It's like that powerful. And we are going to talk about it for a long time to come. So let's look at the new economy as I see it, of course. All right? All right. So let's go to this presentation. I'd like to be out in half an hour. But this is a good. So from next week onward, I want your questions. I'll pick up questions from your discussion. I'm following these discussions, and I'm saying that's a good one. When I see good ones, I'll pick it up. I'll send it to you as agenda. You want me to discuss something, send it to me. Send it to me, and I'd be happy to evaluate and say, yeah, this is a good one. I'll discuss it. All right? Okay, so let's go to the new economy. And I'll sort of breeze through it, all right? I'll breeze through it. That's just my age band to forget that. That's for everyone else. Let's go. All right. So now, quickly, this is an economic term, so this is a macroeconomic issue. So please get into your macroeconomic hats. What's a structural change? That's what's happened in an economist. It's an economist term where we say we had multiple real shocks in multiple markets, simultaneous real shocks in multiple markets, if not all markets. So what's a real shock? And as compared to what? As compared to a nominal shock, what is this? What's a real shock? And what's a nominal shock? Just like real return versus nominal return. In a nominal shock, it's a temporary change in a market. Could be a demand change or a supply change. It's temporary. Things get unsettled in the market for a little bit because of supply and demand, temporary supply and demand disequilibrium, and then it changes back and it's okay. So for example, say a flood in the Midwest leads to an increase in corn prices because of a shift in the corn supply. And, every year there isn't a flood. So some years there are bumper crops and so on. So that's a temporary shock in a market, and it goes away. Spike in gasoline prices, leading to the increased demand for public transportation. So in 2008, when gas prices peaked at 150, people started taking public transportation. Demand for it went up. It was temporary. When it crashed back to 40, everyone was back in their SUVs and their vans and stuff. Right? We know that. Okay. Or say, outbreak of flu, bird flu, swine flu, spike in the price of vaccines because there's not enough supply till the government gets into action. Temporary shocks, and it sort of like goes away after some time and the effect doesn't last. Real shocks are similar, except that the effect lasts in a market much longer. So it could be a supply shock or a demand shock, sudden changes in quantities and prices because of changes in supply and demand. All right? It could be both real or temporary. Real, temporary shocks go away 3 to 6 months, 1 year maximum, and goes away. Real can be longer, 2 to 5 years, sometimes maybe a little bit longer. And examples of real shocks, say the demise of the aerospace industry in California in 1992. Decrease in demand, so the aerospace industry, people got laid off, all right? Same thing happened in Silicon Valley in 1999, dot-com bust. Or say a shortage of nurses, skilled nurses, short supply, increases immigration of Filipino nurses. Now, it's a good employment opportunity. People want to get retooled, right? So now if you look at the nursing schools, they're full because the domestic people realize that's a good employment path, but it takes time to retool. So it's longer term. It's painful. Someone who gets unemployed in 99 or 92 or whenever, for them it was painful, but they retooled and they got back into the economy after retooling from that real shock. Another example of a real shock is an increase in the supply of housing, right? So what happens when these real shocks happen? There's reallocation of economic resources, which are land, labor, capital, and technology. So, for example, a lot of people left California and went to Arizona or Nevada, Idaho, all these areas, Colorado. So the neighboring states, they sort of absorb, and the other industries absorb. In an integrated economy like the United States, the effect of a real shock is that the rest of the economy absorbs the effect of that shock in one market in other markets. So, for example, people will move to Colorado or Nevada or whether, from Massachusetts or from Michigan to Ohio or Michigan to Texas and so on. So, integrated economy, people will move, and that will be one, and they'll retool themselves and become new professionals. So dot-com has become financial planners. We saw that a lot. Or mortgage brokers becoming financial planners. But now we have mortgage brokers and bankers, but they will have new professions in time, the people who got laid off. So real shocks in an economy get absorbed in an integrated economy. Not like, say, in the European Union, if you're a nurse and you lose your job in Spain, you just can't go into Germany and say, hey, I'm a nurse in Spain. It's like if you have the degree in Colorado, you have to take a bar exam in California or something as a nurse to be able to work. In Germany, no, they recognize your education. So it's not an integrated economy. That's why they want to be an integrated economy. But in a wannabe integrated economy, they cannot absorb the real shocks in a market. So which is why the power of an integrated economy. So real shocks are painful because you have to retool. You lose your job, you lose your vocation, you lose family living standards. But it's painful, but it's temporary, even the real shock effects. Temporary because you retool, education, change in career, pain takes as long as it takes to retool. Like whether to become a nurse or to become an IT professional or to become a mortgage professional or to become some next, generation, green tech or something like that, whatever the next generation of jobs are. But it's painful, but that's what happens in an integrated economy. It's endurable. Now, imagine simultaneous real shocks in all markets. What happens? Well, how do they happen? What happens after something like this happens? When was the last time this happened? 80 years ago, we know that. How often do they happen? Black swans, once in 100 years, rare events. How long do these happening effects last? When is the economy going to turn around? Everyone's talking about that. When is the economy going to turn around? And economy is going to turn around in 2012, 2013. So when is it going to turn around? We don't know. So it's sort of like a real shock, simultaneous shock in all markets. It's like a vicious vortex. It's a vicious vortex. And in this case, it was the real estate market. In that case, it was the stock market in the Great Depression. And it starts with the real estate market, goes to financial institutions, the banks, the credit default swaps of the banks, and then it hits the economy, layoffs, which leads to retail because people can't spend money on retail. Retail industry goes, everyone's affected, everyone's lost jobs, and all other industries go down, and they pull each other down, down, down. That's a vortex, that's a structural change. That's what we are going through right now. A real shock in every market. What happens after they happen? Usually regulations, because someone's, name game. It's a blame game. Someone's wants to point fingers at someone else. That you guys did this, you did that, and this one is not good. This bailout is not good. This stimulus is not good. This president is responsible. That president. So let's clamp down. Let's punish some regulations. In this case, they regulate usually the market, which didn't do anything. It was people, not the market, but they'll regulate the market. Happened in the Great Depression, 33 Act, SEC, and in 1940 Investment Advisors Act. It's happened this time too, the Financial Reform Act. Last time, 80 years, Black Swan, 80 to 100 years. It's a poisson. Black Swan is a financial term. A statistical term is it's a poisson event. It's a rare event, very rare. How long do they last? About 80 to 100 years when a structural change happens. We are just getting over the Great Depression effects. SEC as we know it, the NASDAQ, the NASD, the SEC, these ROs, Madoffs. It lasts a long, long time. So we don't know what's going to happen. So what's next? So how do we go forward, as advisors? How do we educate our clients? And I'm very happy for you guys to use this stuff, right? You are very welcome to use anything you have in this class, all right? You want this presentation? Just acknowledge that it's mine, but use it with your clients if you feel it's any good. Now, what do we do next? What happens? To get to from the last depression to this depression, what's happening, we need to stop. We need to stop in the 1970s. And I say 1970s because it's a watershed decade for finance. It's really the birth of modern finance. We've got to touch the roaring 70s first to understand what happened there with markets, all right? And again, in this kind of a thing, when you're thinking 80 to 100 years, this is about as big as you can get economically. You think about like a retirement plan. Retirement plan is at most 60 years, all right? In a financial decision, that's 60 years. That's not that long. And estimate can be longer, one generation, 150 years or 100 years. Think about urban planners. Urban planners will do 250, 300-year plans for a city. Those are long-term macro plans. There's a guy called Kuznets, sort of like the forgotten economist. He also thought big, macroeconomically. Think about imperial cycle, all right? So this is the American empire. We have been on the peak of the empire for the last 20, 25 years. The last empire before us was the British Empire, the Roman Empire, the Grecian Empire, the Persian Empire, the Chinese, the Egyptians. These are empirical cycles, so you're looking at 100, 200-year periods. So think about how great your vision also needs to be, right? It's not just about stocks, bonds right now. You have to think 200 years. That's a graduate. So I know it's like your clients will say what, but it's about storytelling. So this is about storytelling. What happened? It happened in the 70s after the Bretton Woods collapse, and you don't have to go into stuff. But generally, markets started. People in markets, suppliers and demanders, started deciding what prices should be and not governments. Before that, governments were deciding. IMF, World Bank, Bretton Woods. That's what Bretton Woods agreement is. This sign you see out here, that's the 70s, because the 70s was vital. OPEC happened, an unprecedented volatility. So watch volatility. It's very important. Here's what volatility looked like in the 70s. The first one out here, top left, is the U.S. crude oil prices. And that star shows the 70s, OPEC coming in. And then after that, the 80s. Volatility in the crude oil. Before that, it was flat. To the top right, that is retail price index in England from the 17th century to the 20th century, so 300 years or something. Look what happened from the 70s, from 1780 or something. I can increase it, but you can see it later. That's what happened in the 70s to the price index. Bottom left, same thing, U.S. price index from 1800 through 1990 or something. Look what happened in the 70s. Look at in the U.S. dollar Deutschmark exchange rates after the markets floated. This is the start of the markets, the mid-70s. Everything went haywire. Everything went haywire. Markets became deregulated, the birth of modern capital markets, deregulation. And it was chaotic states, new sets of rules, products, benchmarks. This is when options came into being. Futures and options started in the 70s. Since 1975, it started. And whole new set of benchmarks started showing up. And so this tells us, these pictures tell us what happened in the 70s and the birth of derivatives like credit default swaps. Without it, we couldn't have had managed the economy. All trade would have come to a halt if we hadn't derived products of risk management. Of course, they were abused. But this economy, this 1970s, the market economy started. And now, after all these years, with these rules and regulations, suddenly that's changed. This has changed, and we need to understand, we need to help clients understand that these are very difficult times for everyone in itself. There's nothing wrong with that. With saying that it's very difficult times to explain. It's a difficult disease. You're going to try your best, but sometimes, some diseases are like chronic. They can't be treated. Now, this new economy showing up, it's showing up in different forms. We used to be a purely market-based economy. Now we are not. We see, typically when markets go down in a down business cycle, weak companies should disappear. Strong companies should survive. And that's the theory of the market, theory of utility maximization. Survival of the fittest. Taking care of me first is utility maximization, survival of the fittest. If a weaker person goes down, I have to survive, so be it. That's the appropriate aspect of utility maximization. So there's no shame in being greedy. That's the idea out here. So weak companies should go down. But if you protect weak companies, if the government steps in and bails out weak companies, Now you don't have a market economy. You have a suspect economy where you have public sector companies, which are government owned, coexisting with private sector companies, which people own, stockholders own. Government owns General Motors. And the only way General Motors could build cars is for the government to give warranties on cars. The government should have no business warranting cars. It's not the job of the government. We don't pay them to warranty cars. And you're letting a weaker company survive. And that's what happened with, why shouldn't Toyota take it over, or Hyundai, or whoever the heck wants to take it over? Why shouldn't they? Citigroup, $20 billion company being loaned $45 billion of taxpayers' money? Who makes this decision? Taxpayers? This is our hard-earned money. How were we not consulted in making this decision? Why shouldn't we just pay $20 billion and buy it out? Who are we helping out here? Shareholders or people or the public? And it's public funds. So who are we helping when we bailed out Citibank or Bank of America? We should have let J.P. Morgan and Wells Fargo emerge as the stronger banks. That's what the market would have said. Why should we bail them out? Is the public being helped or the shareholders being helped? Why was AIG bailed out? $25 billion owing to Goldman Sachs, because so Goldman Sachs would go down too. So these are not economic decisions, they're political decisions. Because if GM goes down, there are 5 million votes affiliated with GM. Political suicide to let it go down. Right? But it's not an economic decision. It's a social, political decision. That's a new economy. We have public sector enterprises now. So what happened in the Great Dipper? Basic things now. People were lying about financials. Financial analysts, financial, investment brokers, investment underwriters. Everyone was lying about financials of companies then as they were now. No difference. You go back and study what happened in the Great Depression, you'll see. And the 33 Act was all about disclosure, compliance. And so was the 40s Act. But none of these acts, if you look at the Series 7 or the CFP, it doesn't prepare you to invest and manage someone's money. That's not competence. You look at the Series 7, it's a joke for investments. It's a good for compliance, but it's a joke for investment. They just ask you definitions. So is the CFP. The CF is closer. But it was the same problem then, it's the same problem now. We are going to get a bigger government because of the reform of the new public, whatever the reform brings us, and I'll talk about that in a moment. Which means we're going to get back less money per tax dollar of our hard-earned tax dollar because we have to pay more people. The Reform Act now, CEO compensation issue. It's in your face. If I'm a really good CEO of a bank, do I want to work for a bank where the government tells me how much I'll get paid for the best work I will do? Would you? Suppose you are a top CEO. No way. No way. Why should I work bank where the government tells me how much I'll earn for my best work? Personal utility. So that's hello markets in your face. We don't want the good people running banks. What kind of a thing is that? Markets didn't fail. How do you control the behavior of CEOs? By doing this? No, they were at fault. But this is not the way. You're punishing markets, not CEOs. You're driving the best people out of one of the most important industries in the economy, the financial sector. This notional principle and counterparty risk. I know you guys don't get into, most of you don't get into this stuff. This is the credit default swap, notional principle in swaps, $50 trillion of notional principle in swaps. They're saying that you can't do it in the OTC market. That's like telling Citibank or J.P. Morgan or UBS that they're big boys, but they can't look after themselves. They need the government to look after them. Why not? If these big boys want to play with $50 trillion of notional is like funny money principle. It's only in books. But if a company like AIG goes down, it's real money. It's not funny money anymore. And that's counterparty risk. And it's in like not 50 trillion. It's like $500 trillion notional principal in the swap market. $500 trillion. Scary, right? Scary. But who are these big boys? What do they do? When you say, all right, you can't do it, you're basically saying market isn't functioning. Is that true? Is that true? Because you regulate the market if the market fails, a market failure, like a monopoly. That's a market failure. We know that. So you regulate. Utilities cannot charge more than 12.5% markup. We understand that. But where has the market failed here? And what are you regulating? Consumer Protection Agency. Imagine this. What you are selling to your client, that someone is going to, the government is going to protect the client from you. So understand the suitability. Next time if this goes through, you sell a product or not sell a product to a client, your client can say, why didn't you sell me this product? Or why did you sell me this product? They'll take it to the government who will say, my experts are better than your experts. Is it going to make it more efficient for customers? Consumer protection, how complex are these instruments that we buy and sell, like say indexed annuity? How complex is an indexed annuity? Someone's going to tell someone that it's not suitable. I can put an indexed annuity together. You know that. Some of you have seen my presentation. So government is going to protect it, trying to tell someone that this is not suitable for your client. What can you not promise? Again, bigger government. Same as last time. All right. Marks. Whole new set of, this is the big problem with that last question. How do you advise your clients today? How do you advise your clients today? Because the benchmarks are changing. Are they changing? Let's look at them. Whole new set. Macroeconomic, GDP, unemployment, inflation. Rates on stocks. I've talked about expected returns and on stocks and stuff. On bonds, other financial securities. On real securities like real estate, commodities, currencies. On volatility. What are the benchmarks? How are they changing? Here's inflation rates. And you can see since 1950, we haven't had a deflation. Now we do have a deflation. After 50 years, change in benchmark. We thought inflation was standard. We had a big dip, like in the 50s. Look at the 70s and 80s, what happened. Remember the roaring 70s, that's the star mark. Look at what inflation did in the 70s. This is the 10-year Treasury notes, all right? This is the risk-free rate, government 10-year Treasury note, from which most financial securities are priced, like a bond, like most mortgages, all bonds, financial security, even stocks. The risk premium is over the risk-free rate. So this is the 10-year risk-free rate. Look what happened in the 70s and 80s. Does this look startling to you or not? And these are 10-year averages. I averaged monthly returns over each 10-year rate, and I plotted the average 10-year rates. Look what it looks like. How stark is this? Look what the next one looks like. Unemployment rates. Natural rate of unemployment in the US has been 5% for the longest of times. That's the natural, that's Milton Friedman's theory, and it's been like that. Look what is up late. Is it changing? How long is it going to be up there at 10%? Is it temporary? You guys all know it's not. It's permanent. Permanent is how much? I don't know. 5 years? 10 years? It's not temporary. How long is it going to take for us to get these people back in the jobs? And for the young people to find jobs because the older people can't retire. Look again what happened in the 70s. That spike. Can't get away from what happened in the 70s. Savings rate, this is the exercise that, David showed. Look at the savings rate. Look at what happens in the savings. This is the baby boomer generation. People born between 45 and 64, all right? Remember that. But the peak from the 1980s to the 2010, that's the peak of the imperial cycle of the U.S. Our generations before us, generations after us, will not have the lifestyle we had during these last 30 years. That's a peak. That's a peak. We already started seeing it shrinking. We had wonderful times. That's all right. These are long cycles, 80 years, 100 years. Doesn't mean we are going to be poor tomorrow. But that's an issue. If you are 60 years old, when you make a decision, borrow more and spend more, what if you had a decision to make where you could spend today? Let's say the government can spend today and ease your burden, but it'll screw up your children's happiness. Their lifestyles really go down. People are proposing spending more on deficit financing because if you're 60 years old, your life is pretty much gone. You're going to be dead before the bad effects of that deficit comes to haunt us. It's your kids. It's our kids and our grandkids. What decision will we make? Our welfare or our kids' welfare? If we had saved, it was our kids' welfare along with ours. If we spend, it's only our welfare. This is the saving, and I talked about it. The fear of this crisis turned us around saying, oh my gosh, what have we done? Let's at least get back at least 6 months' income before we spend anything. Here's the VIX index. It's very interesting, the VIX index. I want you guys to sort of start thinking this. This is the volatility, daily volatility. So look at two things. Those stars, one is the 70s. No, sorry, one is the dot-com boom, and one is the 2000 dot-com bust, and one is the 2008 bust, the last two big busts, 1998, 99, dot-com boom and bust, and the real estate boom and bust. Look what happened in the volatility. In between, this is from 1990, you see periods where volatility is really low. In the stock market, this is S&P, the VIX index, right? Volatility index. And look at the S&P returns. So whenever the volatility goes down, S&P and stocks do well. As volatility goes up, we are in trouble. Volatility is a good indicator to follow. And look how much daily volatility indicator has gone up. And if you do a trend line, in the last 2 years, it's jumped up 20-30%, the volatility. And as volatility goes up, markets go down. S&P volatility. So now volatility has gone up, expected return has gone down. Benchmarks. What are we going to do? So going back to your questions, how do we advise clients? You educate them. You look at 30, 40 years. This is the best we can do. We'll have to keep it as safe as we can today. Even if you have a 25, 30-year plan, 3 business cycles, what does that mean to me? Can I manage business cycles, 30 years of someone's portfolio? What does it take? What should I put? What's the asset allocation should be to look at that? All right, I got that. So we know that from the 2008, one thing we know, we are part of the world. We are no more isolated. We cannot be, even if we wanted to be. This 2008 crisis hit everyone. We got hit the hardest, by the way. And of course, some European countries got nearly as bad as us. But countries like China and India and Brazil, they fared much better. They were all affected, but their dependence on us, if it starts going down, our dependence on them will go up, and that's a problem. And it is I'll put more pictures. I've got a couple more slides to still come into this presentation of what's happening everywhere in the world, which has an economic consequence. All right, and it's like Back to the Future. What do I say? Fighting the Taliban or G20 or British Petroleum, all sorts of things. New things happening. I thought this was a hoot. How desperate are people around the world? This is how desperate. I can't stop laughing. Norfolk, Virginia had their first piracy-related conviction in 150 years. These guys are this desperate. They are so impoverished. These 3 Somali pirates on that canoe, you see that picture? In the evening, they couldn't recognize this U.S. warship. And they with their grenade launchers, and they thought they would hijack this Saudi ship and make $2 million ransom. And they attacked this warship, the US of A warship, with, the rocket science. These 3 guys opened fire on this ship. And this guy got caught, taken to the US, and they admitted to attacking the US warship. Just imagine how desperate do you have to be to think you can, just attack anyone and take over the ship and think you'll get 2 million. And in this case, yeah, it's oops, huge oops. But that's the way the world is right now. It's like people are really desperate everywhere in the world. A lot of Americans are going overseas for jobs. That's another. It's going to show up in this thing. I wanted to let you know that. Search it in some of the mainstream press. There are opportunities for us overseas. We should be getting them right now. That's a way for reducing our unemployment. One way. Why should everyone keep coming here? We should also go out and make money outside, and we are doing it, but we need to do more. Pessimistic bubble. This is a new chatter I heard. The high price level of bonds. I'm sure some of you know that bonds you can't touch them. They're so expensive. This guy, I think in the New York Times, called it a pessimistic bubble. Imagine, because he said people are being too cautious about their lifetime savings. So this high price of bonds is a pessimistic bubble because people are too cautious with their money. Call it a bubble? It's not a bubble. It's a reasonable reaction. It is scary, and in this fear, I want to be in government bonds. I want to be in some good agency bonds and some muni bonds and, build America bonds. Safest places I can be right now, in the greenback maybe. What's wrong with that? He's saying this is because it's a bubble. It's a pessimistic bubble. Never heard of a pessimistic bubble till now. But this is what we are hearing. Right now, one of the best things to invest in is the tips. Even though we have deflation, at least you'll get your principal back. In cash, if it turns around and there's inflation, in cash, if it keeps on deflation, of course you'll lose. But if it turns around, in cash you'll lose money. In deflation you'll make money. One of the best things are like these government tips and sovereign bonds. Build America bonds, I thought was a great deal. Now they've stopped those. Very little to invest in. And I'm saying, and I don't have an answer for you. If you are looking at me for answers, I don't know. All right. Thank you much. And that's the end of the so let me go back and erase the slide. All right. That is my presentation next month and a little bit more. I'm going to turn off my talk and I want to hear your impressions, please, anyone. You can type, you can talk, as you please. Agree, disagree, and if you agree, disagree, that's okay. If you agree or disagree and you want to talk about it, start part of this chat of how it's related to what we're doing. It is related to what we're doing. Get it into the discussions of whether it's anchoring. For example, in the last 10 years, S&P has made 0% return, right? So anchoring, is that, how does it affect us? In 10 years' time, will we make 0% from stocks or 0% from us? All right, Jacob.
Thank you. Yeah, very good presentation. What I was wondering about when we talked about kind of the notion of too big to fail, and I mean, and from your point, it's kind of saying we must fail for it to normally process. I guess my thinking is are we protecting ourselves enough from the, are we by stopping it now, are we protecting ourselves in the short term but necessarily making bigger impacts for the long term, is what you're feeling?
Very, very good question. Absolutely. Absolutely. If we start shoring up our own economy through savings and reasonable investment, we will delay the process of handing over our empire to the Chinese. That's part of the slides coming up. Absolutely. We have 70, 80, 100 years at least for this economy to be fully down, and the new economy, China will come up in 30, 40 years, will still be a power. We can delay it or we can hasten it. Right now we are hastening it, handing it over, saying we are tired of being at the top. You're absolutely right. There are things we can do to slow this down. And, in my last If you read my column in the Journal of Financial Services Professional, it's about the government. Is the government too big to fail? What's a lean, mean government? That's what it is. Yeah, even including the government, there's no such thing as too big to fail. Then you won't get the strong companies surviving, which means we won't get the value as consumers in a market economy. Yes, please.